Vikas Khemani joins us. Let's take our conversation forward with him. Vikas, great to have you back. Thank you for joining us. It's been a bumper year for investors, so more like a dream year where whatever you bought at the beginning of the year, as the year unwinds, you made money. What is in store for 2022? Low returns, no returns, negative returns.
Hi, Nikunj. I think first of all, I think we have to keep our expectations low as we step into 2022 for sure. I think the market will have a couple of characteristics that we should definitely taper down our expectation, and it will be nothing anywhere close to what we had last year and or this year. So I feel next year would be some of the facts we have to keep in mind that interest rates would be kind of slightly firm, inflationary environment would be there. Market will not be as sort of one way. It will be a lot more volatile in the sense than what we have seen in this year. So if you look at these kind of 3 or 4 things going to be reality, and at the same time, I think the news flow from the international market, especially on the Fed tightening, would keep surfacing time and again because inflation is unlikely to settle down in a hurry. So broadly, this would be the landscape of the market, and within that, then you have to kind of design your strategy. Also, I think there's no doubt in that earning growth, which India has, we have started seeing pick up in India, that will continue. So I have no doubt in my mind that corporate earnings would continue to be robust. But there can be market phases where, despite corporate earning can be being robust, you will have a margin volatility. You will have periods of correction. So all those things would be there. I would not make the case for negative return for sure. I think we will definitely be sort of positive. I feel. And a lot depends on the of course development, but broadly I feel that we should expect mid-teens kind of returns from the next year. Anything above, if it happens, is bonus. But we have to keep in mind the macro landscape of the market with the backdrop of what happened in 2021.
Your big idea for 2021 was IT. You bought IT, you've been talking about IT stocks. We've discussed several times with you on this forum that why you've been bullish on IT. But at the current juncture, given where one side inflationary pressures are kicking in and most of the IT stocks are trading at P multiples which are north of 20, some 25 times, are we in for a patch of no returns, low returns for IT also?
Not really, because I think in some sense, if we have a little bit of an inflationary environment, or I think it kind of helps to keep the rupee a bit weakened, so a weak. I think so. I guess that helps IT sector to absorb some of the cost pressures and keep the margin intact. I mean, we continue to believe that we are in for a very, very strong demand environment. Of course, after every rally, everything consolidates. So it might happen that IT can consolidate, but I would not make the case for a negative return or a correction from here. In fact, IT demand environment is only getting better and better by the day. So I mean, of course, there are other sectors which offer better, could offer better risk, but we would continue to sort of keep our exposure to IT.
See the market breadth moving from here. For this year, 80% of the market breadth has gone higher. 10% of the market breadth has not gone anywhere, or 20% of the market breadth has not gone anywhere. What kind of market construct do you see for 2022?
I see a lot of sector rotation happening in 22. In my opinion, it will not be one-way market. You will have to be very careful and keep looking at a lot of variables, because we are in a market where there are multiple variables impacting companies positively, negatively. So it's not going to be easy market. And sectoral rotation, in my opinion, would be theme. And one sector which I feel you can look at from 2022 perspective, I think it would be banking. I mean, entire BFSI space, but more so specifically banking, because this is the one sector which gets sort of bit of a benefit from a rising interest rate environment. The spreads go high, their margins improve, and also fortunately we are in an early stage of credit cycle picking up. So so I think this kind of if you look at specific sort of tailwinds for a particular sector and then plan your sort of sectoral exposure, you can come out better. You can beat market, but it will require sort of a lot of hard work and a lot of being watchful.
Right. Because I'm just going through your latest note, and while I know what fad means, FOMO means, and fade means, but I don't know what you mean by putting them all together. Fad, FOMO, fade.
So I think we were just kind of trying to explore to people. We see a lot of people are kind of feeling left out. We are seeing in last 1 year, every single day you need the read the news that X Y Z startup has got this, they have become a unicorn. And we are seeing a similar kind of this thing in the IPO market. So we are seeing within the investing community a huge fear of missing out or fear of being left out. And what our idea of telling through this note is that I have seen this, and all of us have seen this in multiple market size. It starts with a fad that gets converted into FOMO, and most people jump into that point in time, and eventually it fades, right? And this is a normal human psychology, and I think we are seeing in many pockets that fad has become a FOMO, and I think it's getting into a dangerous territory. And when we say this, we don't make a point that it is not new age investments won't do that. I've been making case for that. There will be a lot of disruption. There will be a lot of new businesses get created. But in this disruption, when you are buying something from the fear of missing out perspective, you don't ignore a lot of things. You ignore quality of the management, you ignore valuations, you ignore risk reward. And investing is all about risk reward. Unless you factor into risk reward, you will not. Your outcomes won't be desirable. So that's what we are saying, that it's a time to be very, very cautious, time to control FOMO. It's all about psychological. Eventually all these things fades away. We have seen how in 2007-8 cycle, real estate companies and construction companies were trading multiple of their land bank and order book. So in this kind of situations, when the multiples change, now companies are getting multiples of sales rather than earnings. Now these are the clear telltale signs of one has to be careful. If you are seeing a company trading at 20 times sales and still people are jumping to buy, it tells you that something is beyond rationality. So those businesses eventually might survive, but investors might not make money. So this is what we are trying to outline, that investing is all about risk reward, keeping emotional control, not being part of the crowd. Most of the time, being part of the crowd does not make money, and that is what we are trying to outline in this note.
Sure. Interesting. So help our viewers understand, where is it that you see fad becoming FOMO and one should fade out? Any examples that you could give us where, the valuation excess is clearly evident?
I mean, look at lots of IPOs which are going. I have done IPO. I mean, as an investment banker, I've taken a lot of companies public. Right? Look at what's happening in the IPO market today. Many companies, whether it was a Paytm or a car trade, look at car trade example. Again, I'm not pointing a particular company, but today, that time, it was crazy trade sought after. Today, it is half the price, right? So like this, you will see many more, unless, especially under the garb of new age, under the garb of, futuristic, lots of companies are going public, which does not have real case. Or even if they have real case, they definitely don't justify the kind of valuation they do. And also, more importantly, it is very funny. Many times you see that the similar business model, getting all and better business listed already in the market, is trading at half the valuation or maybe 1/4 of the valuation. But then just because it is going public, it's caught the fancy of the market and it's getting valued there differently. I mean, these are the situations we have seen in the past. They don't work. So I would strongly advise people to be very careful and cautious of the IPO market. Do very, very big diligence. Again, I'm not saying that these are the bad companies. Those companies eventually might stay great value, but investors might not make money from the time they invest, and hence one has to be very, very cautious and careful.
What is the outsized bet? Let's say if IT was the outsized bet, can I say banking will be the outsized bet for 2022?
Yes, we are very, very positive. We are significantly overweight, and we think that, in fact, we wrote a note also. The 4 sectors you should, for 22 perspective, look at what we call BRICS: banking, BFSI. Secondly, IT, information technologies, IT services. Thirdly, real estate and related players, because we think real estate is again anti-inflationary. It helps when inflation goes up and demand is turning around. And lastly, because the capex cycle has picked up, capital goods oriented and industrial players would do pretty well over next, and when I'm saying this, of course, stock specific, you have to study. These are broadly sectoral trends we think can do well into 2022, because the tailwind is good for these sectors, and they are also kind of, do better when the inflationary environment is there and the demand cycle is good.
Rajiv Bajaj told ET Now that champions they eat oats for breakfast, and he dismissed what Ola and Ether are doing. But that is not helping the stock and shareholders, because the stocks of Bajaj and Hero MotoCorp, they both are at a 52-week low. Is it a time to be a contra buyer? Do you think this entire electric vehicle or electric two-wheelers is something which is overdone?
So, again, Nikun, to be very frank, I'll be very honest. I think jury is still out. One does not know. And as a philosophy of the firm, what we typically do is whenever any sector which is kind of in the middle of a big disruptive move, you don't have to be there part of it, right? You can just again stay away and watch out till the time your bets are the landscape is clear. And sometimes you will miss out. That's fine. Though my personal view at this point in time that I don't know whether it will be more electric vehicle driven technology which will survive, or new hydrogen oriented plays will come and become large. So still the jury is out, and I definitely believe players like Bajaj Auto have far more wherewithal to deliver, because in EV sector there's not lot of if you ask me technology which people have. It's just, in my opinion, more assembly kind of play most of the people are doing. And if that is the case, I think people like Bajaj Auto, who have a distribution network as well as the brand and balance sheet, definitely can deliver as and when the market, sort of is ready for that. But again, but again, we try to be kind of a little bit careful in these kind of things before we commit any significant sort of capital, and especially when there's a time when you have a lot of other compelling ideas. Why to go and fall into trap of this contra trade and just so that's our thought process.
Because they say that a good business at a bad price is a bad idea, a bad business at a good price is a good idea. At what price you think you would like to buy a Nykaa or a Paytm, or you would say I'll not buy them at all?
No, I will never say I will never buy them at all. I think currently and again, I don't have any today sort of sense that what price I would buy, to be very frank, and it'll be wrong for my part to say that. It depends really what kind of growth trajectory they deliver over next 4 or 5 years. I believe that a lot of growth is already captured in. It's an exceptionally good business, run by a great team, no doubt on that. But for me to make money, again, I have a competing idea, right? Always you compare versus one versus other. From here to for it to double, what it will take, and for somebody like, let's say, any other player, what it will take to double. And if your thought process is clear, that where the risk reward lies, you kind of take the decision. Currently, while we watch Nykaa, but I don't think it is right now even on the radar of risk reward. Maybe once either growth comes surprises or price surprises, we keep monitoring and watching. Currently, we don't think it's really falling into our risk reward framework.
Because I was just going through your recent writings, and you've given 3 examples here, and you've stacked up a Policy Bazaar versus ICICI Lombard, and ICICI Security versus, the next billions, that's Grow, Latent View versus IT services companies as well. What is it that your reading has been when you put, each of them against the other?
Now, again, see, what you have to understand, you always look at the similar kind of businesses, right? And then you try to compare this with vis-a-vis, what it's like. Let's say take the example of Latent View and Zensar. I think we try to compare that, right? One's revenue is the other's profitability, and the market cap is same. Now, I don't have any doubt that Latent View is doing a great job, right? But even if you grow at at the end of you look at the underpinning of the business, Gensar is doing IT services. Maybe that is a slightly low quality talent or lower end of the talent they take and make some money. Latent View is doing higher quality talent and they make money, and the growth is slightly higher, right? But at the end of it, when I look at the growth plot on the chart and look at both companies, I don't feel that risk reward from investing from here is there. Latent View may be a great company and is a great company. I'm not making any case against it. My case is only that right now markets are completely mispricing one versus other. The value lies somewhere else. And it's not that value meaning it is cheap. Even Jansar is growing very well. Other IT services are growing very well. So what you are paying for growth, one has to look at. And I think similar, I mean, ICICI Securities, according to me, and it's a portfolio company, so I must put a disclaimer. It's as good as a fintech, according to me. It's a great fintech. Its platform is very good. It's serving more than 5 million customers. It's making 1,000 crore plus profit versus it's similar valuation of an enterprise where, and I understand this industry reasonably well. I mean, in the similar industry, entity which has not even half revenue, which is closer to even half of its profit, is getting similar kind of valuation. It just beats me that what is that secret sauce? This company will come back and beat this player, and even if they do that, my money is safer in players like ISEC, where I can simply keep compounding. It's not that ISEC is sleeping; they are also competing in the same market, evolving every single day with the technology coming about. They're adapting. So it's not that they are just kind of stuck in isolation and doing nothing. So when I compare these two things, it's just no brainer according to me. But we may be wrong. Markets may be right, but that's how we think, and we feel that rationality, sanity over a period of time kind of plays out. And we are not in this game for 2-3 years. We are in this game for 5-10 years, and our job is to compound, create wealth for our customers and clients, which is a generational wealth. So, and we are custodians, so we have to manage risk a lot more. And in times like this, the risk management becomes a lot more important than anything else.
Okay, Vikas, great to have you on the show as always. And while it's still 15 days left to go before we wind up for the calendar year, but in case we don't meet again, here's wishing you a happy new year from all of us.
Lovely chatting with you, and wish you a great 2022 to you and your team and all your viewers.